Drew Armstrong, Tom Masiero, thank you for joining the Mining Pod. How y'all doing?
Good, Colin. Glad to be here, buddy.
Drew, it's good to get you on. We had Mr. Masiero on a few months ago talk about AI and HPC as that was kind of bubbling up under the surfaces. People were getting more excited about it. Super happy to have you on. And this pod, for our listeners, we're going to be covering a range of topics. We're going to be focusing on Cathedra's plans for the next year or so, this Sats Per Share memo that they put out, as well as some recent news about Synota, and also just the general AI and HPC landscape. Sorry, I can't get away from it, especially with regards to the Project Stargate that was just announced a few days ago. But also love to kind of touch on some of y'all's feelings about Bitcoin mining in the age of Trump. But Drew, we'll kick it off with you first. So this Sats Per Share memo that y'all put out a few months ago, can you kind of walk us through your thinking with that and what we were talking about before we recorded about your mission to increase Bitcoin value per share for Cathedra?
Yeah, absolutely. I think it's pretty simple. If you think about the universe of assets right now, I still am incredibly bullish on Bitcoin. And I think from like a risk adjusted point of view, I think buying Bitcoin is one of the best trades you could possibly make. That's part of the reason why my PA only consists of Bitcoin and Cathedra stock. I just think that Bitcoin is still, there's this massive opportunity here. Obviously we're at 100K now, but I think if we enter the phase where we potentially have nation states beyond El Salvador really adopting Bitcoin and creating Bitcoin reserves, I think there are probably already some that already have that we just don't know about. But I think it's tremendously bullish. And I think there's just this natural, inevitable progression where Bitcoin attracts more and more folks looking for a censorship-resistant store of value. So we, just to give some background on Cathedra, for the last year or so, a little less than a year ago, we announced a merger with Tom's company, Kungsleden, and that business was really focused on developing Bitcoin mining hosting data centers at low cost, which had really attractive IRRs, and potentially also applying that same method to developing AI HPC data centers as well. I think the thing we really loved about that business is that we just thought it was a much more attractive risk-adjusted return versus buying ASICs, and kind of being stuck on the ASIC hamster wheel. Now, I think buying ASICs can still be an attractive short-term trade, but it's unclear to me whether that's really like a sustainable long-term business where you can compound capital over 5-10 years. And so part of the reason why we're really interested in that business is, again, just the more attractive return profile. But ultimately, we're still incredibly bullish on Bitcoin. So I think part of the idea was, by merging with a business that's able to develop these really attractive assets and then compound capital that way, that you can basically juice those returns or accelerate this growth by storing some of your retained earnings in Bitcoin. And so I think when we put out that memo back in September, it really was just us memorializing and putting out there something that we'd all talked about internally, Tom, AJ, Gav, and I. And I think since then, what we've really just done is kind of put out the benchmark that we're going to hold ourselves to in the long run, which is, the Bitcoin and Sats Per Share. So, obviously in the months since, I think we've seen 4 Bitcoin miners issue long dated convertible notes and maybe start to adopt some of these same things. So, it seems to now be like a very in vogue idea, but, I think it's something we've been thinking about for a while. And so putting that out in September before the likes of Mara and Rai, we're issuing these convertible notes, it just seemed kind of like a natural thing to do and an effective thing to just tell shareholders exactly what we're going to be thinking about when we're trying to make decisions about building the business.
Yeah, and we were talking about this as before we got on, and it seems like the Synota deal that y'all recently announced, or partnership, I should say, kind of plays into this. So for our listeners, Synota is a payment solutions company. And as I understand, Cathedra is tapping them for the payment flows for some of its hosting contracts. Can you dive into this a little bit further, specifically on those 2 considerations that we talked about before the pod? Because I think like the first one, it seems kind of dry and boring on the surface, but actually the solution is quite elegant and really helpful for Cathedra and for other companies who are using Synota. And there's the second aspect of it about the auto conversions that I think is interesting. So could you dive into that and kind of explain y'all's rationale for this partnership?
Yeah, Tom, do you want to take this, or should I just
Yeah,
run forward?
you take the first part, and I'll grab that last
Perfect.
part.
So, I think when you're running a hosting business, the cash flow cycles are very different than Bitcoin mining, right? Bitcoin mining, you get payments from the pool every day. You can use that Bitcoin, sell Bitcoin, hold the Bitcoin. But hosting is a little bit different. Number one, sometimes for these power contracts, you have to prepay a month's usage of power. And obviously, this all depends on the PPA, depends on the location. But so sometimes you're talking about paying for a month of power before you even use it. Then oftentimes hosting contracts will not be billed until after month end. Meaning if you're paying for that, prepaying for the month of power a few days before month end, and then the month ends on day 30, day 31, and then there's another week or two sort of payment period thereafter. We're talking about basically a cash flow cycle where you need to prepay for power that you don't get paid for until 45, 60 days later. So I think one of the things that was really attractive about Synota, and shout out to Austin Mitchell and that team. They're all amazing, really smart, and have been great to work with. But you basically can get paid from the hosting customers on a daily basis. And so that potentially means, you're, instead of waiting 45 days to get paid, you're getting paid in real time every single day. And then also their product also potentially works with the utilities as well, in which case you could basically be paying, reduce the capital requirements of the utility, paying for the power, call it on a more of a real-time basis, but also receiving your payments for that power on a real-time basis as well, and sort of booking that spread each day versus a situation where you're prepaying for power that you don't get paid for, till over a month later. So that I think is the first real piece around just improving the cash flow cycles. But I'll kick it over to Tom for the second.
Yeah, I mean, really, as a host and someone who's built the last couple of years of not wanting to have risk exposure to ASICs, what Synota does is it kind of unlocks the ability to synthetically mine Bitcoin via your hosting revenue. And so, if you've got, depending on like your counterparty, whoever your hosting customer is, you can essentially decide on a day-by-day basis which revenue you want to take in via Bitcoin, or stream it directly to USD to your bank account. So I think just like any other business, you're always looking for ways to optimize. Synota, I think, is trying to solve the problem from the energy company's perspective, and this is a solution that I don't even think it could have gotten adoption like 2 years ago. But now that you're seeing probably hundreds of I would say like 10 plus megawatt scale miners that are out there, they become like a valuable asset to a lot of utilities, meaning, hey, we'll be adaptable, with our load. Like this morning, we got a call at like 3 o'clock in the morning from TVA because, they were dealing with an unprecedented amount of electricity usage, and they asked us to curtail. We do that, directly with them. And, so like that, even just doing like these things where the utilities are treating us as like a partner. Now we've got like kind of a payment platform that also kind of works with us, instead of like the traditional way of we just consume this power, we're nobody, and then on the payment side we just get our bill at the end of the month, and then we'd have to go collect getting a bill, the invoice paid, and like there's this whole cat and mouse game. This changes everything, and it's a better way to deal with volatility as well. So yeah, we're excited to try it out, and I think we'll help when it comes to, if it does what we think it can do. It definitely should be able to help when it comes to doing new projects in the future. Could potentially help out with down payment or deposit schedules with utilities. I think we're still a little way off from that, but I think like once they see that there's this ability for them to get like a streaming form of payment daily, it does change things for them.
I think it's a really good example of a technology stack that seems like it should be, or how to put it, it's a technology stack that some people might take for granted, that it's not already kind of proliferated throughout the Bitcoin mining industry, right? And talking about streamlining things for potential new deals, I feel like every little barrier of entry that you can knock down for some of these clients is just another big win. And to me, it just seems to be another example of how nascent a lot of this stuff is, and how there's still a lot of room for growth on a bunch of different verticals within the Bitcoin mining industry that don't even relate specifically to mining. So since we're on the topic of the hosting industry, wanted to get y'all's thoughts on how it's changed, if at all, since the halving. There was a time there where margins were basically non-existent for certain operators, depending on what their efficiency is and depending on their power price. What are y'all seeing trend-wise in the hosting market now that we are kind of, almost a year removed from the fourth halving?
Yeah, I think from my perspective, it's definitely gotten more healthy since basically early to mid-December. The market's kind of, I wouldn't say picked back up to where it was, but the hash price has increased enough where you're starting to see more competitive pricing for hosting contracts. When I would say competitive, I mean like north of 7 cents per kilowatt hour, whereas from about August through pretty much December, it was non-existent. You're talking most of the deals were, sub 6 cents. A lot of them were trying to get down to like whatever your cost of power is and doing like, unique or, creative like profit shares. That was it. That's all you could take. And so, now you're starting to see deliveries of newer generation machines. They can, play the game where they can say, hey, we'll pay 7.5 cents, and be able to do their thing. So it definitely has rebounded. I think like having steady price, like where we've been sitting in this range, this, 100 to 90 to 105, it's good enough to kind of keep those things going. So yeah, we'll see. But I mean, it's like dog years in Bitcoin mining. Like
Right.
the entire world will change in like 2 weeks.
So just so I'm understanding correctly, was there like a dynamic where hosting providers, some of them felt like they had a back against the wall because they had these PPAs that they were on the hook for, and they couldn't necessarily allocate rack space to fill that PPA? Maybe they didn't have their own ASICs to deploy in the place of hosted clients, so they really had to come down on their prices in order to fill that rack space, or else it just
Yeah.
would go to waste and they wouldn't be actually monetizing that energy.
Yeah, there's definitely like a waste aspect. Some PPAs have take or pay kind of commitments to them. I think it's just the standpoint of in every cycle you're going to get squeezed, and if you want a long-term hosting customer, there were times I think like when we went into some difficulty adjustment periods where it was not profitable for some of our customers to mine, and we kind of like this is even before the merger. We made some like agreements, like, for a certain month and just said, hey, how about instead of like you paying, whatever, 7.5 cents, we'll do it at whatever, percent or whatever, like 6.5 plus a certain rev share till hash price increases. Cause like at the end of the day, we want to make sure our customers are going to be able to be plugged in for a long period of time. And so you just got to be, kind of adaptable. The interesting thing in the hosting market though is, and there's this cycle. Core Scientific fell into this like a couple years ago, where they built this massive hosting business, and then Bitcoin goes on this crazy bull run, and they start seeing dollar signs because they're like, well, you know what, energy prices are going up, Bitcoin price is going up, so they aped into ASICs and basically like booted all of their customers in some way or fashion.
Right.
And so it's a natural inclination for hosting infrastructure owners to eventually go long ASICs. It's just the timing aspect of it being right. And so I think you saw some of that this cycle as well.
I feel like we've been seeing that too from a lot of public miners. They've been really shaving down their hosted segments. Part of that is maybe it's a little bit biased because Core Scientific right now is doing that because they're trying to make way for an AI retrofit, right? HUD 8 has done it in part, I think, because they lost so many facilities when Mara bought the Generate Capital assets that Generate Capital appropriated from the Compute North bankruptcy. BitDeer's hosted segment, I think, grew marginally by like 100 petahash year over year. But I've been curious about that. Like in times of extreme stress, like we had after the halving, would it not, am I wrong in thinking that it would be in a miner's best interest to maybe shave down some of those hosted contracts and host their own machines? Or is it just the kind of push and pull of profitability where the customers might not have the ability to actually furnish those contracts anymore? Does that make sense?
Yeah, it does. I think really where the crux of it is mostly in like new machine availability. And
Yeah.
because there's been this like kind of like a constraint on getting S21s, there isn't this like natural machine to upgrade to, to do it yourself. And so, there's a flood of like J Pros that are out there, and yeah, you can do some good things on like the like firmware side, but everyone's got them. They're plentiful. Then next in line is like XPs. And so I just think, you've just got to either you have access to capital where you could, get machines, but there's no like this the funnel for a brand new Bitmain machine being released like every 6 months just isn't there anymore. And so I think you just got to be more strategic when it comes to the rack space play. I don't know if Drew, you have any thoughts?
No, I think that's I definitely agree with that. I think there's also an element though where post ETF, it felt like a lot of miners last year were basically choosing their own adventure, whether it's like the Bitcoin beta and side of things, and like maybe going the clean spark approach of sort of doubling down on Bitcoin mining. Maybe the other approach would be Core Scientific, where it's pivoting much more into the HPC market. And so yeah, like I think given that sort of bifurcation, and given the fact that a lot of pure play miners are already thinking about the ASIC, they're already on the ASIC hamster wheel anyway, right? Of all competing to try to get the 50 exahash, 100 exahash first. I think it was natural for a lot of them to maybe focus on the higher upside business of prop mining instead of hosting, right? And I think if I'm not mistaken, I think Core Scientific is basically sunsetting their hosting business altogether, or they announced that last year. And so they were like the first institutional hosting business. So I think part of it just people wanting additional upside elsewhere. But I think there still is, one of the attractive aspects of the hosting business in general is the fact that think about the Kungsleden historical cost to develop a site of around 170K per megawatt. If you're comparing that to the cost of say filling out a megawatt of S21s, we're still talking about like 90% of the capex going into the ASICs. And so, right. I think you're able to be much more patient when you own the infrastructure because that, is a much longer lived asset than a new Bitcoin mining ASIC. And so I think, again, that's really one of the key benefits of the hosting business. If you can really control your cost per megawatt to develop a data center, is that your return, the capital you need to return and earn a return on is just so much lower than if you're buying a brand new ASIC. And so
that's
again,
view horizon. I feel like that's an underappreciated point. You're not overextending yourself. I mean, not to keep using Core Scientific as our go-to example in this, but I feel like they're a really good kind of reference case for a bunch of different things in the Bitcoin mining industry. I think Adam Sullivan's done a pretty good job of turning that thing around. But part of the reason why they went bankrupt is because they took on so much debt to fill that rack space that they built out, because they built out just gobs of megawatts, right? And then they bought the top of the like S19 rollout, like a bunch of other miners.
Yeah, so, I mean, I think you're totally right. Like, and we also entered into futures order around that same time, so learned a similar lesson. But I think it's also just worth, again, to your point, why did they do this? They did this because in Q3, Q4 2021, you're paid to be long ASICs and you're paid to have a massive contracted hash rate. And so I guess, again, it sort of depends on like really what the North Star of the business is. If the North Star of the business is to keep announcing growth so you can keep pulling on your ATM, like you kind of get caught in this vicious cycle where you're sort of forced to do that versus taking a longer term approach of like, we want to increase our Bitcoin holdings over the long term. That means, sometimes it may go down, sometimes it may go up, but like that's, if you're orienting yourself towards that, then it's maybe a little bit easier to play a game. And it's also just worth pointing out that there is a time in every cycle where it's good to go long ASICs, right? If you bought ASICs in May or June 2020, you did pretty well. And so I think, there's sort of a different strategy for different seasons. And so while it's easy to dunk on people buying ASICs, like there's often a time where it's, that's really one of the best things you can do if you want to outperform Bitcoin or earn great returns on capital. But right. Certainly, as you're saying, it does backfire at times too.
The perverse thing is that to your point, the smart money way to long ASICs is at the bottom of the cycle, obviously. I mean, that's not a genius thing to say from my end, but that's the smart money move, but that's not always what the market would reward, right? Like the part of the reason why these miners would just ape into ASICs at the peak of the cycle is because investor interest was at its hottest point in Q3 and Q4 2021. But then you create this scenario where there's almost no way the company is going to be able to ROI those ASICs. And then you have these terrible scenarios like with the ASIC backed loans where you have, handfuls of exahash being defaulted on and shoved back in the hands of financiers. On this note, this is like we've kind of gone into this realm of lessons learned from the last cycle. Were there lessons learned for Cathedra in the last cycle that has kind of pushed it more towards wanting to be an infrastructure play and hosting provider rather than pure play mining? Has that kind of been the rationale behind a lot of the recent business decisions?
Yes, absolutely. And so I think, maybe to rewind go back to that last cycle, Cathedra had a 2 megawatt data center over in Washington, or I bet this is back when the company was called Fortress Technologies, but a 2 megawatt data center over in Washington. We'd entered into a partnership with, coincidentally, the old company that Tom founded, Great American Mining. Or actually, I guess in hindsight, it's certainly not a coincidence. But yeah, basically, and so in going into Q4 2021, we saw some of the bottlenecks happening with on-grid data center development. We looked at just the massive white space that there was in off-grid mining, and so we basically doubled down on that direction. Started we raised a convertible note with a 3-year maturity to buy ASICs in a futures order, because again, one of the lessons we learned from the previous cycle and AJ and I's time with Amanda Fabiano at Galaxy Digital Mining was that there's basically this chicken and egg problem. Do you start with the infrastructure or do you start with the ASICs? And what we had learned from our experience was that the ASICs are always kind of the scarce commodity. Now, that's one of the key learnings that changed. I think then also we were really focused on trying to develop our own modular data centers up in a factory in New Hampshire, because again, we wanted to control our own supply chain. I think that was another lesson there where, the supply chains become really crazy near Pico top. And so the supply chains aren't necessarily always crazy, but certainly when everyone's raising a ton of capital to deploy mining infrastructure, the supply chains are crazy. So, again, I think we thought, so that's maybe mistake number 2. Lesson number 3, we also thought that maybe, dare I say, we're entering a super cycle. And so we were thinking there's no way the Fed can cut forever. We were completely wrong there. But, these were sort of some of the key lessons we learned. And then maybe the 4th lesson that I think we really learned was we looked around at a lot of the other miners in, Q2, Q3, 2022. And it sort of became clear that this phenomenon we're talking about now, this ASIC hamster wheel, wait till the bull market, raise capital, buy machines at the top of the bull market and kind of ride them all the way down. It became clear that, maybe this actually was not the pure play Bitcoin mining, the big box mining, as Tom used to call it, is maybe not the most sustainable business model, insofar as, you're always needing to refresh your fleet. You're always needing to buy new ASICs and grow your hash rate. And so I think that basically it gave us like a very sober view about the industry and the game we're playing. And I think it made us really, we've been working with Tom at Kungsleden. And I think that was one of the things we loved about the Kungsleden business on the whole, is that it's sort of this is a completely differentiated approach of developing these low-cost hosting data centers, being able to compound capital because of the attractive return profile. And I think, Tom had asked this question back in summer of 2022, and it really stuck with us. How can you perhaps mine Bitcoin without ever having to buy an ASIC? And I think that was like one of those insightful comments that has really, stayed with us. And so, yeah, I'd say there were many lessons that we learned. I think everyone who gets into Bitcoin mining, there are no shortage of lessons to learn, no matter how smart you think you are when you first get into it. But yeah, the other reality too, in light of all those lessons, is that things are always going to be changing, right? You assume that you can rent generators for 3 cents a kilowatt hour, 3.5 cents a kilowatt hour. That could change. There are many things that could change, whether it's with respect to supply chains, energy markets, ASICs. If we end up in a world where there are 3 or 4 different manufacturers making 10 joule per terahash machines, that potentially changes things even more. So at least those are some of the key lessons that I learned. But yeah, it certainly has been an informative last 3-4 years here.
Yeah, if your models aren't flexible, they're not very good, are they? That's one of the things that I've often chuckled at when you see people modeling out there, especially some public miners. They'll say, we're going to make this amount over this time frame. And it's like you're assuming a flat hash price and flat energy price. Going back to this infrastructure play thing, it reminds me of the age-old adage, the people who got rich in the gold rush sold the shovels or built the towns. It wasn't the people who actually tried mining for gold. And perhaps in Cathedra's case, the better, a way to modify that saying is Cathedra's selling the gold fields because you're building the infrastructure. I want to dive into Kungsleden on that note, now that we're kind of on that topic. And Tom, if you could just kind of walk us through Kungsleden's thought process and the business model, and also maybe at the end, if you could touch on what we were talking about before we hopped on with regards to the North Dakota site and how there might be some flexibility here, whether or not this electrical infrastructure is used for Bitcoin mining or other data center needs.
Yeah. So, I mean, the big thing is like we're really long rack space, right? And so rack space and power adjacency is like the thing that we focus on. And how we got started with our sites in TVA are, these 10 to 15 megawatt sites in TVA in rural areas that we target, and they're mainly used for Bitcoin mining. They really wouldn't be a great use case for AI right now because most I would say like AI use cases, like you hear this like Stargate thing that was brought up yesterday, $500 billion. They really need to do all of that in like one centralized place. And so for now, these like smaller, these smaller loads, like, sub 50 megawatts, even sub 100 megawatts is still more is better for Bitcoin miners right now. When you start getting like larger loads, like the site that we have in North Dakota in a JV, that's 60 megawatts. And in theory, that site would be better suited for AI. And so, I think that's like what's going to happen this year. It's like you had a lot of folks who are, even Riot mentioned something yesterday that they're going to stop build out on Corsicana, and then they're going to try to, evaluate, what would be the best use case for it. And I think there's a world where, you've got these companies who have, like right now, you're just going to see companies race to get as much power as they can, and then figure out how to make the most money off that power. That's kind of like the thing. And I don't think anyone actually has cracked it. Now, the markets, they get, it's like one side I'm thinking from like, the actual fundamentals of the business, mindset. And then your other side is like your markets mindset. And they're usually not connected because, I think the markets are still trying to chase like what comes next, right? Coming out of last year, the Bitcoin proxy, narrative moved out of Bitcoin miners completely into ETFs and MicroStrategy. Gone, right? Then Core kind of like stole the show with this like pivot into HPC AI, and that has been like a positive thing for those particular companies. And so now you're kind of stuck with folks who are these mullet miners, and I still think there's like a level of identity that we all have to form in terms of what this business is actually going to look like for a lot of us that are kind of playing the mullet game, meaning we've got some Bitcoin mining operations and doing data center build out stuff. But the data center build out stuff right now is still, it's like it's out there. It's not actually an operation. There aren't, I would say, like long standing existing counterparties to say, oh, this is going to be a great business. There's a lot of like hypothesizing around, oh, well, if this takes percentage of the traditional data center business, well, then we know how to ascertain a value from it. The problem is it's not the traditional data center market. It's a high density compute market, and it's more like a Bitcoin like mining world than it is a data center world. But yet the economics seem to be more focused on like a data center build out and economics. And so I just think we're still early with it. And so I think the theme you're going to see, you started to see it in 2024, the end of 24, is companies going out and acquiring lots of power and access to lots of power, and then having that power and having the optionality to do different things with it.
I mean, it's a completely unproven pivot, right? Bitcoin mining itself is already so nascent. And to Drew's point and his prior answers, there's so many learning experiences that miners go through each cycle. They're constantly reiterating, they're constantly taking in mistakes and trying to improve on those mistakes. So I guess my biggest question with the AI and HPC thing, and I've asked this before, so I'll try to ask it in a different way. Is it even that possible in the way that it's being described? And I guess the way that I would ask it now is, since Core Scientific is really the guinea pig here in terms of large scale, right? Riot's doing some evaluation to see if they would just be better off selling Corsicana to a hyperscaler. Lancium actually just came out today that they're going to build like a 2 or 3 gigawatt site in Childress, Texas, with Drew smiling. I'll ask you about that in a second. In concert with Crusoe, if Core Scientific's first phase of the CoreWeave deal, which should be completed either at the end of this year or the first half of next year, is successful, does that create a race to the entrance for this kind of business model? Or is it too late at that point for these pivots or these? You're saying no. You're saying no to that it's too late, or you're saying no to that it creates a kind of like race to do the same thing?
I'm saying no, that it's not too late. Like, I think we're actually in like the infant stages of things right now.
Yeah, I'd agree with that. It's also worth pointing out that the race already started last year when
Yeah.
Core Scientific did announce that CoreWeave deal. And I think maybe one key thing to point out there, or there are two key details there. One, it's an amazing deal for Core Scientific because CoreWeave is effectively financing the development of the retrofit, right? And so that's hugely important, because if you look at just some of the industry standard numbers, like if you talk to one of these big HPC data center consultants, it's like $10 million a megawatt hour. $10 million a megawatt for CapEx. And then if you think about just the lease payment and you assume that's all margin, right? You're talking about a 6-year payback, right? Mm-hmm. So with that really only makes sense from a Bitcoin miner's point of view if they unlock that financing and if they're partially financing it with that. So Core Scientific had that. They have a reputable customer locked in. Like, that's a great deal. And then, of course, a lot of folks then after them when chasing into this HPC market too. So the race already began. But I think the second key point is that, as you said, the whole thing won't really be finished and developed, I don't think, until, 2026 is when the full, is it 270 megawatts is supposed to be retrofitted?
I think I'm going to fact check this by getting the recent investor presentation, but I think they have like 3 phases, and the full thing won't be done until like 2027. I think they were promising, though, for like the first 100 megawatt phase, either at the end of this year or 2026. But I'm going to check that real quick. No,
but to the I think, thank you for the fact check, and also I think that's sort of the key point, that this hasn't even really been some of these key development stages haven't even been completed yet, so it's still incredibly early days. And I think it's definitely a very interesting market to be in. It's also an interesting thing to look at when you have guys like Macquarie and some of these big PE mega funds that are really putting a bunch of money into this HPC development for hyperscalers. Obviously, $500 billion from Moshe Son's also a large amount of capital to deploy. I think you are going to see some differentiation in the market, where I think so far a lot of it's just been talking about, tier 3 data centers sort of been one of the commodities that's been really in demand in the last year. But I think when you have that much capital rushing into the market, I think you're going to start to see some differentiation between the types of data centers. And, it's not just all going to be, we're all building the same thing. Now, I think, again, in this business, we really like the Kungsleden approach of maybe focusing on being long rack space or focusing on the power versus trying to buy the GPUs ourselves. And I think one of the key things about that is just, again, if you're competing with Microsoft, Amazon for some of these GPUs, they have a lower cost of capital. They also are putting together much larger orders, and it's not dissimilar to ASICs, right? If you're saying I want to buy 100,000 ASICs, you're probably going to get a better marginal price than if you want to buy 1,000 ASICs. And so I think these are some of the key dynamics where there are some strong parallels between Bitcoin mining and AI HPC. But as Tom said, it's still very early days.
Yeah, a few things I want to touch on there. I really think it bears repeating that you're in this industry, AI HPC, you are going toe-to-toe with some of the most heavily capitalized, influential tech companies in the world. And it's almost like a track runner trying to do, like it's like trying to do the 1800 or 1800 or whatever versus like the 40-yard dash. So like you got to kind of figure out what you're good at. Bitcoin miners, to do it right, are good at building infrastructure. we've yet to see if they're actually good at deploying GPUs, en masse. Fact check for the core scientific thing. This seems incredibly optimistic to me. They expect to have 200 megawatts online at the end of the first half of this year, and then 270 at the end of the second half of this year. We'll see if they can nail that timeline. That seems optimistic to me, but I don't know. Maybe they can actually square that. The other thing too, going back to the infrastructure play, been very confused by some of the miners who have tried to cash in on the AI and HPC hype, to your point, Drew, by purchasing, 100, NVIDIA H100s or H200s. I'm not even really sure what they're doing with those half the time. I mean, usually they're hosting them at some other site. But to me, that seems to be kind of a high time preference play for this, trying to just get a press release out saying that you are actively involved in this without actually doing any of the groundwork to flourish in this business line into the future. I don't know if y'all go ahead, Tom. You seem like you.
I was just going to say, I think there's two ways to think about it, and it really involves framing, right? Like there's this idea of LARPing, which, I would say like a LARP in this particular scenario would be like not buying the machines. The fact that they bought these GPUs means that like they've got some skin in the game, and they're willing to, like I actually have some respect for the companies that are doing this. That means like they're risking, like there's some risk there. Obviously there's operational risk, execution risk, and then figuring out like even a business model. Like, okay, do you have a customer that's going to buy all of that compute? Okay, well that's one model. Are you just going to sell that compute like on, some of these platforms that do that? Okay, that's another model. But like, at the end of the day, like, if you have a public company in this segment, you're gonna have to continue to evolve. That's just or die. And so I think like the more like the more things kind of change with like the landscape as far as like, if you think about it, less than a year ago, there wasn't even clarity. Well, no, there was a little bit more clarity. Like, there was a period of time where like we didn't even know if you were Bitcoin mining in the US, if like you were going to get kicked out of the country. And then within like a very short period of time, you have Larry Fink, basically just, christening Bitcoin adoption, and then it becomes like mainstream. And now it's just this like kind of like parallel tracks between AI and Bitcoin being like as synonymous with apple pie as being American, right? And so like it's trying to figure out like, okay, well, if we know that that's kind of like this ongoing trajectory, where are things going to go? And I would say you're going to see lots of Bitcoin mines being built to be a utility provider's like backbone, like a curtailment partner as part of like critical infrastructure. Then you're going to see data center stuff be looked at, specifically HPC AI, to be looked at as national security infrastructure, and that's going to have its own little element. And so the fact is like there's going to be a lot of experimentation that's going to take place between the miners, and I think it's going to be a long time before things really get played out, in terms of like, oh, that was successful or not, because the market really doesn't, because it's such a new segment. Everyone's looking for, oh, what's going to be like, who's going to be the biggest, who's, like it's not defined yet. It's not like, I always go back to think about when Google came out, and like, if you think of like the Magnificent Seven or whoever, like the big fangs and stuff, they weren't like, those categories weren't even really defined when they came out. They had to be companies that lasted 5 to 10 to 15 years before, now if you look, like there's tons of SaaS companies that are out there now that are great companies, but before like would never be able to do that. And I think like we're going to just see a maturation process over the next 5 to 10 years in energy focused like Bitcoin mining and HPC compute sites that is going to change dramatically over year to year.
I'm really happy you brought up the existential question of Bitcoin mining and really kind of just the broader Bitcoin industry in the US. I'm assuming that was in reference to things like Operation Choke Point 2.0, where basically there was this unofficial attempt by agencies under the Biden administration to debank tech founders, which included crypto and Bitcoin companies and things like that. So for our final question, fellas, I would love your takes on what, if anything, or what changes do y'all anticipate with a Trump administration that seems to be more friendly to Bitcoin, more friendly to Bitcoin mining, seems to be trying to encourage AI innovation within the U.S. with Operation Stargate. What kind of changes or impacts do y'all foresee over the next 4 years?
I'll let you go first, Drew.
Oh, I was about to kick it over to you to go first. All right. No, I think there are a couple things. I guess one, going back when I was a Bitcoiner before I even really was working in Bitcoin mining. I never really thought we would see a U.S. government be pro Bitcoin. I'd assume that there would always be this antagonistic relationship. And you basically wonder, like, how long can Bitcoin survive? How much can it grow before it's just inevitably going to be under serious attack? And I might disagree with folks like Shinobi that what we're seeing right now is a state attack, but that's another story for Bitcoin Twitter. I think it's kind of amazing to see the U.S. government wake up to this and wake up to not only say, like, maybe the importance of the asset of Bitcoin, but also to just the importance that this industry can have for our country, right? I think ultimately Bitcoin is, my view is that it is sort of just a technology, and that there's not necessarily obviously maybe there are political implications with some of the design choices, but I definitely think that Bitcoin will be adopted globally because of its utility. But it does feel kind of like fundamentally an American technology if you compare the USA to other countries around the world. And so I think it's great that the US is embracing Bitcoin as this freedom technology and as something that is good for America. And so I think we'll probably see, it seems like we're already seeing by the day, more and more metaplanets or Semler Scientifics or MicroStrategy sort of adopting this Bitcoin treasury strategy moving forward. I think that's going to be one key change. I think it might also be nice if we can finally get some assurances from the government in the form of laws and regulations talking about the importance of self-custody and the importance of Bitcoin mining as a load balancing service. So I kind of view it as just sort of an accelerant where we've entered a new phase in the chat or a new phase in sort of the timeline. And because we're now at this point where if the US government accumulates a Bitcoin strategic reserve, you're obviously going to see other governments around the world do this as well. And so I think we've kind of just hit this like key catalyzing moment where, how many years did it take us to get from $10,000 to $100,000 Bitcoin? Was it, roughly 7 years? And now I think 100,000 to 1 million seems almost trivial. So I feel like the same inevitable conclusion of Bitcoin being adopted perhaps as a global reserve currency, it seems like we're still on that path, but it seems like that end state might be pulled forward by decades, given how the US government is now embracing Bitcoin. So I think it's all hugely positive. It does mean more folks are going to get involved in the industry. And so, a lot of times a lot of the folks that maybe get involved don't always do the homework and really understand a lot of the key technologies. I think we'll see more people trying to fix Bitcoin now, perhaps. But I think it is really, really positive. And so what it's really just meaning is that we've kind of just put some jet fuel on the fire. And I think things are going to grow much, much faster now.
The bull pill.
Yeah.
I love it.
Yeah. Yeah. I mean, I always liken these type of questions to like when Marty, who's one of our board members and, obviously good friends, when he talks about getting cosmic, because like, if you think of like what's happened, like in the last like 2 years, it's like, is this like real?
It's a fever dream.
So yeah. So it's like, okay, let's just ride this wave. And it's like, well, what does that wave mean? That means ASIC manufacturing will happen on U.S. shores. Like major ASIC manufacturing will happen on U.S. shores. What else does it mean? It means there will be, like you're seeing, an initiative for strategic Bitcoin reserves happening at the federal and state levels. You will see initiatives for every state and municipality to have some exposure to Bitcoin mining that acts as like a load balancing requirement. And I just think it will become ubiquitous in the next 4 years, and we're going to look back and be like, it's going to be like kind of how we're looking back now. I think we're just getting started.
Love it. Yeah, it seems like we've definitely reached an inflection point. I mean, like the ETF was huge for boomers, I think. My father-in-law, who's been always incredibly skeptical of Bitcoin, which is hilarious because it's like building my career around it. But that's beside the point. he said, oh, so the ETF is like institutional acceptance. And so I think for him, a lot of Bitcoiners cringe at that because it's kind of contrary to everything that they like to build, not necessarily their identity around, but the way they view Bitcoin, right, as this as this countercultural revolution. He viewed that as, oh, this is something that's safe to invest in. And I feel like everything that we're talking about with regards to state acceptance and other things are downstream from that. But anyway, we're up at time on the hour. Drew Armstrong, Masiero, thanks so much for joining, y'all. Really appreciate it. Before we hop off, a quick note to the listeners where they can find y'all, where they can find out more about Cathedra, all that stuff.
Yeah, so if you're interested in learning more about Cathedra, I recommend going to cathedra.com or following us on Twitter at Cathedra Bitcoin, all one word. And there you can find latest investor presentations. You can find our Bitcoin strategy memo. You can find previous shareholder letters that kind of maybe outline the evolution of the business. And then I'm also, on Twitter, the app formerly known as Twitter, at _Drew Armstrong _.
Tom?
Likewise. Just find us. Just find Cathedra on Twitter, and you'll eventually find us.
Yeah, you got to find Tom too. He's Farmer Tom. He posts about homesteading and Bitcoin mining. You love the combination. All right, gents, really appreciate y'all joining. Have a great week. And for our listeners, appreciate y'all. We'll see y'all next week.
Awesome. Thanks, Colin.